And John, sorry, on that point as well, a lot of LPs that we've spoken to about the holdco structure, they just don't even have like a process of like they have all these like established processes of like how they look at the 2 and 20 funds.
Yeah.
And they like don't have a process of how they would even begin to look at a holdco. For some of them, it's like a new opportunity, and then for some of them, it's a hurdle, right? It just depends who you're talking to.
Yeah, I think that's completely right. And what I found is when I showed up with LPs with a fund and a fund structure and something that they understood and was they looked at other things like this. Obviously, the fund I'm showing up with, we'll talk more in future site, is a little different than a VC fund. But when I show up with that, they basically see more trust, at least in my experience, where they're like, oh, I can compare what you have and your LPA to other things I've looked at. I have an investment process for that. And now the challenge, I think, on the fund side is that 2 and 20 construct is like essentially what I found with, I'd say medium sophistication level investors, is that 2 and 20 structure is something that basically is trust, like quote unquote trust to them. And when you start to freestyle on it and change a lot of it, they start to be like, oh, wait a second, maybe I'm going to get ripped off or something like that. So there is a lot of trust embedded in that 2 and 20 kind of common structure that not trust with you, but trust that that's been well negotiated in the market. And so that's, I think, another key piece. Okay, I'll just add, I think, a final point, and then we can move on. I think the other piece here, now this varies based on jurisdiction and how it's done, but typically on a flow-through fund versus like a corporation, or in the US a C corp, you have better tax treatment. So you have the ability to, when you sell an asset, that flows through directly to the LPs versus getting taxed at the fund or the corporation level. So so that can, in a bunch of cases, reduce the number of levels of tax that are incurred, and that's another like tax benefit. Of course, in the US, you can do LLCs and other things like that where you get similar type of benefit. Okay, I think this was good. It was a good conversation. Let me just stop this real quick. And I'll share one more time. Okay, so let's run through a few of the different models. We're going to go through 4 models. So the simplest model here is a single studio model. You have a venture studio, let's say a corporation. You raise some money into that corporation, and then you spin out new companies. And it's fairly simple. And this is, I think, a very common starting place. Why not? It's very simple. You set up a corporation. Maybe you're a founder before. It's very easy to do. You know how to do that. And you raise some money into it. You have to do some deal with the LPs in terms of what percentage of the corporation they would own. And then you spin out new companies. And the first opportunity here for you is to notice, maybe the most important thing on this slide is the 1 next to Venture Studio. You see that? The Venture Studio 1? So you have to have a deal with your investors that says, hey, we're setting up this corporation. We're going to raise X millions of dollars. And the deal is that we're going to build companies for a certain number of years. And then we're going to shut down this company. And we're going to start a new one, a Venture Studio 2, a Venture Studio 3. And so this is very important to kind of, if you can kind of arrange it with your investors, for them to be clear that they're investing in an episodic investment program. And they can continue in the Venture Studio 2 corporation to do that. Now, what happens if you don't do this? If you don't do this, if you don't have this conversation with your investors and structure it properly, you will have Venture Studio Corporation with no 1 there. And when you are finished deploying the capital, you'll go to maybe your investors or a new set saying, hey, I want to do more, but you're going to keep substantially diluting the corporate entity. And so generally, if you can pull it off, what you want to do is make sure this is a corporation that the investors have an understanding that it's episodic, and you've captured that idea in your in your legal agreements. Because at the end of this, if you're going to do the Venture Studio 1, 2, 3 thing, you're going to need to say, okay, we're going to transfer the IP from Venture Studio 1 or whatever IP, the brand of your Venture Studio. Obviously, most of the IP that you create is going into your new codes, but let's just say something as simple as the brand of your Venture Studio and the team. You're going to need to transfer that from corporate entity to corporate entity, from the Venture Studio 1 to the Venture Studio 2. And so then in this structure, you do have then the ability to have different follow-on investors, and that could just be directly into the companies in this case that could invest. And so in exchange for spinning out these new codes, the Venture Studio receives founder shares in the company.